Hi, welcome back to another video. You ask the questions, I'll answer. So this will just be a very short Q&A video, especially so when the market has such exciting developments. I just wanted to take the time to connect with you guys, and I posted in the community tab what questions you guys want me to answer. So of course, for those of you who have not subscribed, not liked the video, just remember to subscribe and like. So first question from Vincent. You are great in analysis and going deep dive on companies. Would you pick up macroeconomics and history to build a stronger foundation and pillar to make your analysis complete? Thanks for your compliment. I don't really think that my analysis is great. There are a lot of people much better than me, and more importantly, because I was not trained in a professional setting. I didn't join any hedge funds. I didn't join any bulge bracket banks. A lot of my musings online on the YouTube channel is just my own thoughts, and I just bump into a wall, learn something new, and then just share my thoughts online. So based on understanding on diving deep on companies, I think it's just my own natural inclination into trying to understand businesses. Particularly on my YouTube channel, I cover two main business here, Facebook and Alibaba. I think regardless of what companies you're interested in, as long as you put in the hours, you will probably know the company on a much deeper level compared to your peers or compared to people that have not put in the hours. That's just pure hard work and perseverance. So technically speaking, I wouldn't say that my analysis is much stronger or I have a much greater analytical toolbox compared to others. On the second part of the question, on picking up macroeconomics and history, so personally I'm quite interested in reading myself. So I do take a very keen interest in terms of what happened in the past. So the 98 financial crisis, the dot-com bubble in 2000, 08 great financial crisis, the subprime mortgage, the COVID crash, etc. So ultimately, we have to understand in the stock market, we are betting against human psychology. The stock market is essentially just an aggregation of how people think, how people act, and how people feel. So at the end of the day, I believe that understanding history, understanding how people think, the psychology of the markets is extremely important in understanding how the market works. So yes, if you haven't noticed, I'm quite a reader myself. But that being said, I think youth is a double-edged sword in itself. You're aggressive, you're vibrant, you're extremely keen in learning and understanding, but your experiences is where you actually lose out to your older counterparts compared to, for example, my dad. My dad has went through much more market cycles compared to me. He's much more experienced, he's seen a lot more compared to me. So in order to match up the experience compared to people like him, is to learn from people even older than him, like Warren Buffett, Charlie Munger, etc. The second question from Stockado. If you had 100,000 today, how would you invest in it, Tay? I cheekily answered in the comments, all in Bitcoin answered. For the record, this comment is a joke. So I think just to provide some perspective, I do run a pretty concentrated portfolio, at least on an individual basis. If today I had 100,000, let's assume that it's on top of whatever I have today. Given the age that I am right now, which is I'm currently 24, given my age, given what I understand of the world, I will still run a rather concentrated portfolio, but maybe not 80 or 90% into a particular stock counter. I will probably at max diversify into 3 or 4 companies maximum, and to really pick up the necessary skill set to look into different companies and to understand how to play the markets. At the end of the day, let's not forget, when you're young, you are probably broke, but you have a lot of time on your hands. When you're much older, you probably want to adopt a much more prudent approach in trying to diversify into bonds, equities, and also within the equity class itself, diversify further. Next, from Firekiter, what is your favorite food? Contrary to popular belief, I'm actually not a very picky eater. I eat anything from Western to Chinese to Korean to Japanese. I eat everything. I don't really spend a huge sum of my money on food, but however, my guilty pleasure is really to be indulged in technology, which is why I have all these different gadgets with me, and I spend a huge bulk of my time and my money on embracing and understanding technology on a much deeper level. I don't have a favorite food. To me, food is probably just a mechanism to survive. Next question from Suresh. If let's say you meet Jack Ma at a private meeting, what would you ask with respect to China as a whole? I think the first question I would definitely ask him is, why did he say what he said in 2020? What was behind the scenes? And if it's candid, I would like to understand the full picture. Fundamentally, when I look at Jack Ma, I know that he's definitely a people's person. He doesn't have the technical skill set and the technical knowledge compared to other people like Bill Gates, Elon Musk. It's extremely evident when you see the conversation between him and Elon Musk at one of the conferences some time back. So thinking from this perspective and understanding the persona of Jack Ma, I was really curious into what was going into his brain after understanding China for the last 30 to 40 years, what made him so triggered into saying something like that and to portray himself like that? I think on the second part, into understanding China on a much deeper level, I really wanted to get his insights into understanding the consumers and the minds of the people in China today. There are still many question marks into why huge conglomerates in the US fail to penetrate into the Chinese market. For example, Walmart. So let's not take into account those tech companies that was essentially banned in China, like Facebook. So that means that the US market and the Chinese market definitely has their own slight nuances. And I would like to know from his perspective, after running Alibaba for good 20 odd years, what are the different nuances and characteristics of the Chinese consumers that investors should be particularly concerned about. So the next question from Iwan or Iwan, your 2030 price target for Alibaba is still at $1,000? Lol. I think previously, for those of you who have been following me for quite some time now, this channel is actually quite old, for those of you newcomers. I did set an Alibaba 10-year price target at $1,000, I think at the earlier part of 2021. So actually, I think if I'm not wrong, if I remember correctly, the $1,000 price target is actually a 10-year projection. So a 10-year projection from 2021, it should technically be 2031, but it's technicals. So let me explain to you why I had this projection of $1,000 for Alibaba. If we were to look at it, let's not look at price targets because we know price fluctuates and we don't really know whether the companies will split shares or do a reverse split, etc. So judging from Alibaba today, a $1,000 price target means that it commands around a $2 billion market cap. Looking at Apple or looking at a lot of all these different big tech companies in US, they are worth $2 trillion today, which is last year. In fact, Apple is actually worth close to $3 trillion last year when it was bidded up to $170, $180. You're telling me in today's context, 10 years later, the two biggest and the two most valuable tech companies in China, namely Tencent and Alibaba, is not worth $2 trillion? I don't believe. But that being said, if we were to revert back to just looking at pure numbers, and we have to just look at the free cash flow generated, the profits, the margins, etc., I'm going to release a new DCF updated video. But of course, within the last year, after they reported the numbers, they essentially got decimated. So I think rather than framing it in terms of a relative basis, where if we were to compare to the US counterparts, I think $2 trillion is not really a very hard valuation to reach. But if we to just fall back onto DCF, fall back onto the numbers and to look at the company's business model and how they're going to be projected forward for the next 10 years, there are still quite a huge amount of skepticism in terms of whether Alibaba will reach that $1,000 price target. I'll be releasing my updated DCF video before the end of this month, so look forward to that. But in terms of reaching that $1,000 price target, on a relative basis, I don't think it's hard for any Chinese companies, especially the two big tech companies, to reach a $2 trillion market valuation. But from a numbers perspective, I think in 10 years' time, probably reaching around 500 to 750 is probably the base case for a lot of all these different projections. So that's a long answer to your short question. So the next question from Polka. How do you think that renminbi versus the USD are going to develop in the coming year? What is your guesstimate of the bottom of the S&P 500? Mine is around 2,500. So there's two parts to this question. Let me answer the renminbi to USD relationship first. I think there's this increasing divergence in terms of monetary and fiscal policy. The Chinese market is intending to stimulate the economy. They want to cut tax rates. They want to try to build more infrastructure. While the USD, on the other hand, is trying to increase interest rate, trying to dampen demand, trying to decrease inflationary pressures. That being said, as the USD continues to increase interest rate, and there will definitely be more demand for the US dollar. So ultimately, at least in the short to medium term, the US dollar is definitely going to appreciate against every single other currencies out there. And there is this interesting graph from Creation, who is a moderator in our Discord chat. Shout out to him. He did this plot and you can see that the US dollar just keeps appreciating across the board. However, I just wanted to put in a kicker. You have to understand that the renminbi is still a very controlled currency. The Chinese government is going to manipulate the currency however they like. On the second part, what's your guesstimate of the bottom of the S&P 500? Short answer, I don't know. I'm not going to guess where is it going to bottom. I'll still follow my fixed set of principles, understand the companies you're buying in, understand the valuation they are paying for, and just wait it out. I don't have to guess where S&P 500 is going. So next question from So. What is your circle of competence? What are you buying right now? So I'll definitely not jump out and say that, hey, I know e-commerce inside out, I know tech inside out. But I do think that I have some sort of affinity with all these so-called tech companies. I wouldn't say that I have a very strong circle of competence in a single industry. I do know certain industries more than others. However, for investing specifically, I do follow a set of principles that I tend to develop over the last few years. I do follow them religiously. So in terms of circle of competence, I'm still building them up. In terms of investing framework, I'm still testing it in the market. Next question, what are you buying right now? So I think especially when the market goes down, it's extremely important to do your homework. It's a good time to take the time out to study companies and to think about why the companies will win in the next 5 to 10 years. What am I currently buying? I'm probably still dollar cost averaging into the two index, the Vanguard Total and KWAP. Separately for individual companies, I have stopped buying Alibaba for quite some time now. I'm looking to enter more Facebook positions. I want to add into my Facebook position. And I'm also currently studying some other companies that I don't want to say first. I will probably do videos subsequently within the next half a month or within the next 1 month or so. So look forward to it and subscribe if you want to carry on with this journey. So next question from Diraj. What does your Mount Rushmore of investors look like if you have one? And what would you say is your latest and most profound insight you have had about your general investing framework? For example, how you think about intangibles, amortization, or share-based compensation, or your search strategy. It's a very thick question. Let me try to unpack the question first. So what does your Mount of Rushmore of investors looks like? It's probably people that I respect and people that I follow. I think it's your standard Warren Buffett, Charlie Munger. We all probably kind of identify ourselves as value investor. However, I do take extra precaution in trying to dictate how I identify myself as. I don't technically look at myself as a value investor or a growth investor, etc. But I happen to buy stocks that value investors like. I just prefer companies with a very interesting risk-reward profile based on my own investing framework and how I evaluate the risk-return framework. More importantly, rather than just quoting very famous people's name, I would believe that my father as an investing figure has influenced a lot of my investing decisions. But that being said, he didn't write a book. He doesn't have a CAGR of 20-30% for the last 60 years, unlike Charlie Munger and Warren Buffett. But it's always the small conversations that I have on a day-to-day basis in terms of understanding the markets, understanding the psychology of human beings, and the market cycles that he's been in. Those are the small instances that I learn bits and pieces here, and I form my own picture. So he is probably one of the better investing figure that influenced my mindset and my framework. Next up, I'll answer the third question first. So how do I think about intangibles, amortization, or share-based compensation? And this idea of a brand premium itself, it's an intangible asset. How do we dictate that how much is this Facebook value worth? How do we ascribe a value to Amazon as a brand name? We can't. So it's a lot more art than science. We can't really say that, oh, Amazon is worth 1 trillion because its brand is worth 200 million. We can't. But don't be too excited when a company reports a huge amount of goodwill. Remain skeptical, but a core part of your analysis still has to take into account strong brand names. On the second part about share-based compensation, it's a silent killer. As long as the company just continues printing share, they're diluting shareholders. I don't have better things to add, but whenever you do your valuation model, regardless of whether is it discounted cash flow, you use EV, EBITDA, price to sales, sooner or later you'll be diluted away and you don't even know how you died. Next question from the humble chartist, should we quit YouTube? I think it's ultimately up to you. It's a personal decision. For me, I like to record my own sharing and my own learnings from the stock market on the channel. With or without people watching, I'll probably continue posting YouTube videos. So that's just my own decision. I think last question from K4iros. With everyone and their dog saying a recession is coming, why shouldn't we go cash and reinvest later? I know it's quote-unquote timing the market, but things can't get better unless inflation lowers or peace talk starts, and none of this seems likely in the near future. I will not answer this question in this video particularly. I'll make a separate video answering it, because especially so when more and more people are telling you that you shouldn't buy the dip, you should time the market, you should wait for a while more. So with that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!